Let me start with a story that hit me hard. A few weeks ago, my uncle, who's 65, suddenly felt severe pain in his chest. We rushed him to the hospital. After tests, doctor said he needed a stent. Thankfully, it wasn't life-threatening. He recovered quickly. But while we were all emotionally shaken, my dad dropped a bombshell on saying he doesn't have a health insurance. Not for himself, not for his wife either. And honestly, that shocked me. But then I realized something even more disturbing. This isn't rare in India at all. In India, about 83% of senior citizens don't have any health coverage. This means the vast majority of elderly people are financially exposed to major medical costs which can devastate family savings and security. So at that moment, my brain started spinning. How could this happen? What do you do when your parents or elderly relatives don't have health insurance? Is there still a way to get them covered? Or are the doors already closed? In trying to answer these questions, we reached out to Swapnil Shinde from Ditto, who knows this space deeply. And trust me, if you are in similar situation or you know someone who is, then this video is like your emergency handbook. Let's answer the first big question. Can people aged 55 and above still get health insurance? Technically, there is no fixed upper age limit. Insurers are supposed to offer policies at every age. But here's the reality. Many applications get rejected. Why? Because at that age, people often have multiple medical conditions like high blood pressure, diabetes, cholesterol issues, high BMI, etc. And insurers see this as high risk. 3 or more conditions usually raise a red flag. Sometimes, even worse than rejection is something called a waiting period. You get the policy, but you cannot claim for pre-existing conditions for set number of years, generally around 3 years. That means, if your parent buys a policy at 70, for the first 3 years, anything related to their existing conditions won't be covered. Imagine paying a high premium for 3 years while they have to cover serious medical bills out of their pocket. It almost defeats the purpose of insurance. So what's the workaround? Here's one approach that one can use. Add your parents as dependents on your corporate insurance policy if you have one. Corporate policies usually come with no waiting period or strict health checks for dependents. The only catch is if you leave your job, parents lose that coverage. See, if you have corporate insurance, that's often first go-to. But before you assume it's enough, most corporate policies only offer around 3 to 5 lakhs in cover. For a serious hospital stay in a big city, that's just not enough. So one option is a top-up, an additional policy that kicks in when the corporate limit is exhausted. But experts, including Swapnil, suggested that you should still consider a separate personal policy for your parents. Think of it as a second engine in an airplane. You don't want to fly on one alone. Now let's talk about the other option, that is floater policies. Instead of individual plans for each parent, you can buy one floater plan where both parents are covered under a shared sum insured. This often comes at better pricing. For example, a 10 lakh floater policy might cost around 21,000 to 23,000 for one person. But adding another person doesn't double the premium. It usually goes up by around 45 to 50% instead of 100%. However, floaters can become less advantageous if there is a large age gap. Insurers often price the policy based on the oldest person. The good news, many floaters now have a restoration benefit, which means if one parent uses part of the sum insured, it can be replenished so the other parent still has the full coverage. Check with your insurer/advisor when restoration kicks in, how many times it restores, and whether restoration works for the same illness and the same person. By the way, you can get more such insightful stories and perspectives every week in our newsletter, Mind Over Markets. Now let's get into something that makes everyone pause. Money. If your parents are above 60, premiums can easily be in 55,000 to 1 lakh per year range. That's a lot of money. But unfortunately, that's the market reality. Premiums also depend on whether you are in a metro or a non-metro city. Here's an estimate shared for a metro floater policy. 10 lakh cover for 2 people. around 50 to 55,000 at the age of 61, around 74 to 76,000 at the age 66, and around 97 to 99,000 at the age of 71. And that's before something called loading charges. Loading charges are extra charges added on top of the base premium if your parents have pre-existing conditions. For example, if your parents have BP or diabetes, you can expect the premiums to go up by 10 to 30%. Some insurers apply loading, some don't. You can also purchase add-ons to reduce waiting periods. For example, bringing down a 3-year wait period to 1 year or even 30 days, but that also adds to the cost. Also, these premiums don't stay constant. They keep going up with inflation. Some insurers increase premiums in jumps every 5-year age bracket, while others increase them more gradually year by year. Either way, you should assume this cost will rise as your parents age. Now, the obvious follow-up. How much coverage do you even need? A simple thumb rule that Swapnil shared was that start with 5 lakhs. Then add another 5 lakhs for each of these. If you live in a metro city, if you prefer chain hospitals, if you or your parents are above 45, and if there are other medical issues, add them up and the ideal coverage can reach to 25 lakh rupees, and that's really the minimum you should consider. When people look at the premiums, a question I hear a lot is, why not just save the money ourselves instead of paying premiums every year? That's understandable. But here's the problem. A health fund can be wiped out with one big hospital bill. Insurance, especially with restoration benefits, can refill after a claim and protect you against multiple or long-term treatments like chemotherapy in the same year. That's something a savings fund simply can't do. So yes, claim rejection is a real fear, but if you disclose everything upfront and stay disciplined with premiums, rejections are much less likely. When people see senior citizen premiums, the first reaction is shock. For many Indian families, these numbers feel simply unaffordable. And that's why this part of the video is extremely important, because there are ways to structure insurance smartly so that you don't overpay unnecessarily. These aren't hacks. These are real design choices inside insurance that can dramatically change what you pay every year. First one is top-ups. This is usually the first thing people explore because it sounds too good to be true. Lower premium, more coverage. Why won't you do it? A top-up is basically a second insurance policy that only starts paying after your base policy is exhausted. Let's take a simple example. Say you want 10 lakhs of total coverage. You can either buy a straight 10 lakh policy or buy a 5 lakh base policy plus a 5 lakh rupee top-up. The second option almost always works out cheaper. Why? Because the top-up doesn't kick in from rupee 1. It only activates after the first 5 lakh is already used. Since the insurer's risk starts later, they charge you less for that portion of coverage. There's another interesting thing about top-ups. You can even take a top-up without having any base policy at all. In that case, the top-up kicks in after a certain amount of hospital expenses are paid by you in that year. It's like telling your insurer, I'll handle the first X amount of money. After that, you please step in. But this is important. Top-ups aren't always as clean as they sound. For practical reasons, top-ups are separate products with separate claim processes. Sometimes there's no cashless facility. Sometimes there are room rent limits. And sometimes they don't integrate smoothly with your base policy. So this is one area where you must sit with your advisor or literally grill the insurer on how it works in real life and not just on paper. Second are the deductibles. This one is very sensible but also underused. A deductible is simply you telling the insurance company, I'll take care of the small bills, you take care of the big ones. So you might choose a deductible of about 25,000 to 50,000. That means every time there's a claim, you pay the first 25,000 to 50,000, and only after that does the insurance kicks in. And this makes sense when you think about it. A 40,000 hospital bill is uncomfortable, but it won't destroy your finances. A 4 lakh bill might. And a 10 lakh bill will absolutely make a lot of difference for most families. By agreeing to handle the smaller hits yourself, you reduce the insurer's workload and risk, and in return, they reduce your premiums. Not every insurer offers it, but if it's on the table, it's worth serious consideration. Third is co-pay. Co-pay is where you agree to share a fixed percentage of every hospital bill. So if your policy has 20% co-pay and the hospital bill is 10 lakhs, you pay 2 lakhs and the insurer pays 8 lakh rupees. This is why co-pay is usually not recommended, because the exact moment when the money is already tight and emotions are running high, you are still required to bring in large chunk of cash. Having said that, if premiums are becoming completely unaffordable and you are willing to take that risks, copay can bring that cost down. Just don't underestimate it. What looks like a small percentage on paper can feel very heavy when a real medical emergency hits. Number 4 is room rent limits. Most people don't realize how much this affects premiums. If you restrict the policy to a single private room instead of a deluxe or presidential category, the premium comes down. And it's not just because the room itself is cheaper. Hospital price almost everything based on the room category. Doctor charges, nursing charges, even procedure charges. Higher room is equal to higher everything. Insurance companies know this and they price that risk in. So if you are okay keeping the room's entitlement modest, it can make a meaningful difference to what you pay every year. Number 5 is EMI or installment options. Some insurers allow you to pay premiums in EMIs. On paper, this sounds convenient, but in reality, it's not a great idea. Health insurance is already expensive. Turning it into a monthly loan with interest just adds another pressure. A far better approach is to treat insurance like an annual bill. Start saving for it every month through a simple recurring deposit. Assume premiums will rise by around 10% every year and plan for that. That way, when renewal time comes, it doesn't feel like a financial shock. Now, before we wrap up, there's one option you must know about, especially because it's free and many people still don't know about it. It's called Ayushman Vay Vandan. Under this scheme, every Indian citizen aged 70 and above, regardless of income, is eligible for 5 lakh of health insurance per year. This is in addition to any private or other insurance your parents might already have. So it doesn't replace anything, it just supplements it. The scheme offers cashless treatment at thousands of impaneled hospitals across India, both government and private. But enrolling isn't always smooth. You do Aadhaar KYC on the Ayushman app and then download the health card. Sometimes OTPs fail, sometimes verification stalls. Patience is the key. And yes, claim experiences vary, but having this cover is better than nothing. So now let's quickly understand what are the 5 things that you clearly need to remember. Number 1, check eligibility early. Buying insurance sooner is better than waiting until the conditions develop. Number 2, corporate cover alone isn't enough. Consider personal policies too. Number 3, compare floater versus individual plans. Floaters are usually more cost effective. Number 4, expect premiums to rise with age and health issues, so plan accordingly. And number 5, government schemes like Ayushman Vay Vandan can fill gaps, so don't overlook them. There's an old saying, doctors can mend the body, but peace of mind comes from being prepared. Insurance doesn't guarantee health, but it does give you one less thing to worry about when life throws a challenge at your family. Your parents took care of you. Now it's your turn to take care of them. I hope you like this video. See you in the next one. Until then, happy investing.